Hello and welcome to Skills to Pay the Bills. In today's segment of Just Ask Freeman with me, your host, Freeman Owen Jr., and my co-host and beautiful wife, Carolyn Owen. We're the owners of Financial Sources, Inc., and our purpose to make sure that you're informed and educated about safe money programs, especially for your retirement and for your business and your family. Carolyn, what are we going to talk about today?
Okay, let's get started. Well, Freeman, we've been getting a lot of calls with people interested in probate, and we've gotten questions such as, how long will it take for my loved one to receive my estate? And also, people want to know what will happen to the estate after the principal dies. So, Freeman, what is probate, and what are the pitfalls?
Okay. Probate consists of court proceedings, which dictate how the estate will be divvied up among their heirs. And it concludes all your legal and financial matters after your death. The distribution, it can be very complex, and we're going to talk about that to some degree. And today is based on largely how probate started back in medieval times. And again, it's going to be very, very complex. Now, if you want to know about some of the pitfalls, all right, time is an essence. There is approximately anywhere between 9 months upwards to 2 years just to process the probate proceedings. Now, it depends on how complex your estate is.
Okay.
That determines the length. If it's very complex, what can happen is it can last anywhere between 3 and 5 years. How about that?
That's a long time. And I'm thinking over the years, much of the legal system has been made much more accessible and easier, but the probate is just as lengthy and complex as it ever was. So does the probate court help come at a price, or is it free?
You best believe it comes at a price. As a matter of fact, before an heir even receive any of the properties or any of the legacy, there's approximately a 6 to 10% fee that is assessed. Then comes the creditor claims. So before any liens are paid, or before any of the heirs receive any type of the legacy, there's a nice 6 to 10%. And then once the probate process has been concluded, then we worry about the creditor claims and the fees, the attorney fees, etc., that is applied through the entire process.
Okay, so it sounds like it's lengthy and expensive.
Exactly.
And then my last question on the pitfalls of probate is this: what about the privacy of the family?
Okay. Just about anyone who has the savvy can go to a county courthouse and actually look at the records, pull those records and find out what you're leaving to your heirs. Now, I want to say there are strategies to prevent that. Well, number one, to prevent having your legacy going through the probate process is get an estate attorney, all right? And therefore you can have a living will or a living trust to dictate how those monies or any part of that legacy is sent to those heirs. Another strategy, let me add this too, Carolyn, is that there are financial products that are used. Now, life insurance, which is a tax-free death benefit.
That's true.
Okay, and then those monies can be used to pay for probate or estate taxes. The distribution also from a life insurance policy, which is basically tax-free, can also help pay estate taxes. Now, another product that you can use is either a fixed index annuity or a fixed annuity. Now you dictate, or I should say you designate your beneficiaries properly. Then those monies that you've set aside for your loved ones bypass probate completely. The reason being you have a contractual agreement with a large insurance company. All right.
Okay. So there are strategies, but you have to seek professional
You
help.
have to seek professional help. And one way to do that, you can come to our website, justaskfreeman.com, and we do have information there where you can contact an estate attorney.
Okay.
All righty?
Okay. Well, I'm going to switch the gears a little bit and talk about taxes. When must taxes be paid on IRAs and employer-sponsored retirement funds?
Okay. Now you have the traditional IRA, and you also have employer-sponsored retirement funds. They are tax-deferred accounts, which means they're typically funded with pre-tax dollars. Those monies in which you get paid your salary, you set aside X number of dollars, and it's not taxed until you make a distribution from an employer-sponsored retirement account or an IRA. And usually those taxes, when you get the distribution, they're taxed as ordinary income.
Okay, because that was part of my next question, how withdrawals treated for tax purposes, but also, are there any exceptions to the rule?
Oh, there are some exceptions as well. Now, suppose you're under 59 and a half and you take a distribution from your employer-sponsored retirement account. Now, employer-sponsored retirement accounts, I'll describe some of them for you, Carolyn. They are TSPs, thrift savings plans, which a lot of federal employees have.
Yes.
The 403B, a lot of educators have that type of employer-sponsored retirement account. And you also will have the 401K, the private sector use that, and of course IRAs. Now, if there's a withdrawal from an employer-sponsored retirement account, well, you're subjected to a 20% withholding right off the bat. Now, suppose you're under 59 and a half.
Okay.
There's an additional 10%. And this applies to the IRA as well. So, of course, the taxation on, and I don't advocate using your employer-sponsored retirement accounts or your IRAs as an ATM machine.
Yes.
All righty. Now, here are the exceptions. You can have a Roth 401K. And you can also have a Roth 403B or Roth IRA. These funds are funded with after-tax dollars, and they're referred to as qualified distributions and subject to federal tax if you don't meet the 5-year rule. So there's a 5-year rule when you have a Roth. You pay your taxes up front. And if you're under 59 and a half, well, the distributions are all tax-free.
Okay. Now we're going to get into what I've heard you talk about, the rule of 72. You know, it's important before making any investment decision that you know what the real rate of return is on your investment.
Exactly.
So how long does it take for your money to double?
Well, I'll define the rule of 72 for you.
Okay.
I'll share a short story. I know that for the most part, most people aren't taught this simple definition on how to make money compound and double. Being a former mathematician, I never learned that until I got into the financial services business. Here's the definition of the rule of 72. When you divide the number 72 by a percent of interest, it simply indicates how long that money will double. I'll give you a real easy example. Let's take $1.
Okay.
Let's get 4% interest. All right. Well, with 4% interest, you divide 72 by 4, which is equal to 18. So if you have $1, it should be approximately $2 in 18 years, $4 in the next 18 years. Now we add some zeros to that, Carolyn. Okay. Let's take 100,000. So in 18 years, you should have approximately $200,000. Now that works well with interest rates between 5 and 20%. Compound interest is very critical to an investment growth, whether your portfolio consists solely of a deposit account, or you have monies in the credit union, or you have monies invested in the market. Compound interest compared to simple interest, and I'll define the two. Compound interest is where you get interest on principal and on interest. Simple interest is where you get you receive interest only on the principal. Okay, so this is an easy way. The rule of 72 is to determine compound interest. You also have to take in consideration too inflation.
Yes, that was my next question.
Let me see if I've got it. Before we take a break here, I just want to mention the fact that, let's take, for example, if you're earning $50,000, 4% inflation. Now, we know the rule is 72. In 18 years, if we have, let me put it this way, if we have $50,000 of income, 4% inflation in 18 years, how much income will we need to maintain the same quality of life?
100,000.
Exactly.
Okay.
You can see. So we have some methodology, simple strategies, easy to understand, compound interest and the rule of 72. Again, I'll refer to our website, justaskfreeman.com, and I've got quite a few blogs on how interest works and how the rule of 72 works. Okay?
Okay.
All righty.
So are we going to break now? We're going to continue?
No, I think we're going to continue right along.
That sounds
We've
perfect.
got a few minutes here.
All right.
All righty.
Well, then I have some more questions for you.
Okay, I'm glad.
How much money can you put into an IRA or employer-sponsored retirement plan?
Well, IRAs and employer-sponsored retirement accounts are subject to annual contributions. There are limits to those contributions.
Okay.
In 2014, we can place into a IRA, we can contribute up to $5,500 to that IRA. And if you're over age 50, well, you can add another $1,000, that's called a catch-up. Now, with the employer-sponsored retirement account, you can put as much as $17,500 into that account. Okay. And with the TSP, 401ks, 403bs, you can add another $5,500 in catch-up. So I think the IRA and employer-sponsored retirement accounts are great accounts to have money set aside for your retirement.
So if I had the $7,500, $5,500, can I put $7,500 in one account and $5,500 in another account,
No,
or how does that work?
You cannot do that.
Can't do that.
You cannot do that. It has to be a total of $5,500, whether you had a Roth and a traditional IRA. The total for the limits are $5,500, and there are salary or income limits as well. Okay. Well, look, we're going to take a short station break, and we'll be right back after these special announcements. And I want you to stay with us. Don't go nowhere.
For some folks, saving for the future is easy, but for you, it might take a little more effort. Saving for your future is your responsibility, and there's a lot to save for.
I never thought of that.
Like your child's education, perhaps uncovered medical expenses, or just to be sure you can live the way you want when you retire. The time is now to save for tomorrow. Save now or work forever. The choice is yours. Choose to save.
Well, welcome back to Skills to Pay the Bills and today's segment of justaskfreeman.com. Carolyn and I are focusing on some critical topics today. The pitfalls of probate, when to pay taxes on your IRAs and employer-sponsored retirement accounts. And we also are learning how long it takes to double your money. And we're also going to talk about what is an IRA rollover. We're going to discuss transferring funds from one custodian to the other and making it a non-taxable event. But Carolyn, what I'd like to do is continue a little bit more. Like in the last segment, we were talking about how much money to put into the IRA. I'm pretty sure our viewers want to know to go over some of the taxes with the distributions from these IRAs and most employer-sponsored retirement accounts, and share with them that the money is taxed as ordinary income and subject to an additional 10% federal income tax penalty if you're under 59 and a half. Now, we're going to move toward saying that. I wanted to talk a little bit more about the IRA rollover, okay, and how that works.
So, Freeman, what is the IRA rollover?
Well, let's put it this way. If you leave a job and or retire, you might want to transfer the funds that you have in an employer-sponsored retirement account. Some of the problems, I'll use the word pitfall, some of the difficulties that you have leaving your monies in an employer-sponsored retirement account after you've separated from service is, number one, you can't make any more contributions. Two, there could be fees that a lot of 401ks and TSPs and 403Bs, a lot of employer-sponsored retirement accounts are subject to fees on those accounts. Now, you can do an IRA rollover, or you can do a rollover if you separate from service and go to another employer. You can transfer those funds that that has been accumulated in that employer-sponsored retirement account. But I would recommend that you roll over the monies from that employer-sponsored retirement account to an IRA. Well, number one, you can eliminate a lot of fees. You can have more choices as far as allocating your monies to various parts of your portfolio. Secondly, it can be a non-taxable event because you maintain the tax deferral. You can transfer your savings to an account at a private institution or of your choice, and you can have a choice on how you invest your funds. Now, I want to mention too that you also will have a better opportunity to designate the beneficiaries properly with an IRA, and that will carry us in this segment when we talk about the stretch IRA, non-spousal IRAs. And so I want to elaborate on that some more a little later on. Okay. And it's a lot easy to manage an IRA. And of course, with an IRA, you avoid some of the restrictions that you experience with the employer-sponsored retirement account. All right?
Okay, so consolidating
makes a big difference to you.
Okay.
All right.
Now, what is a Roth IRA?
Well, a Roth IRA is a tax-favored financial vehicle that enables investors to save money for retirement. Of course, there are some stipulations. All right. You can. What is happening is that you're able to pay your taxes up front. You avoid the mandate distribution like you have with a traditional IRA at 70.5. Now, here are the stipulations. You pay your taxes up front.
Okay.
Two, there's a 5-year waiting period. And secondly, if you're over 59.5, the distribution from that Roth IRA is tax-free. Now, here's what happened. I've seen happen a lot of times. We ended up getting the clients. Some clients that we got before they came in our fold, in our firm, and asked for help. They converted their traditional IRA into a Roth, but they took the distribution from the traditional IRA, so they were taxed. They were taxed on the distribution from the traditional IRA, and then of course they paid the taxes in order to set up the Roth IRA. So what our viewers can do is come to us and go to our website, justaskfreeman.com, and learn and find out where do you get the monies to pay the taxes up front. That is the key. And you keep in mind that Roth IRA distributions are free of federal income tax. However, they may be subject to state and local income taxes. That's something else too. Eligibility to contribute to a Roth phases out for some taxpayers who are in the higher income brackets. All right. So you can continue, if you're 65 and older, continue to claim your qualified medical expenses that surpass the 7.5% adjusted gross income through 2016. A Roth can help you get those deductions for your meds and for your health care.
Okay, and what are the contribution limits?
Want me to repeat those again?
Yes.
All right. The contribution limits for the Roth, all right, is $5,500 and a $1,000 catch-up if you're over the age of 50.
Okay.
All righty. Again, I'll repeat for the employer-sponsored retirement accounts is $17,500.
Okay.
And then you can catch up at $5,500.
Okay.
All right.
And my understanding is that even though the IRA distributions are free of federal income tax, they may be subject to state and local income taxes.
To some degree. Now, I would ask the viewers to check with their tax professional and see whether or not the contributions or any of the distributions are subject to state and local taxes.
Okay.
All right, but we do know it's tax-free at the federal taxes.
And that's a good thing.
That's a good thing.
Now, I've heard about the stretch IRA, but what exactly is that?
Well, it's not anything special about it except that, we're husband and wife.
Okay.
All right. And so a lot of our legacy would be, if anything would happen to me, joint tenants with rights to survivorship, well, you would get my legacy and I would receive yours.
Yes.
But what about our children? How about that? What about our grandchildren? How do we pass the legacy down to our kids? Now, that's what our viewers want to know. We had the Pension Act of 2006 that was enacted for there was a provision there for non-spousal legacies that could be passed on to our kids. Well, it's also referred to, the stretch IRAs are also referred to as the multi-generational IRA.
Yeah.
Here's how it works. Now, the thing is, we let the IRA funds accumulate tax-deferred as long as possible. All right? Now, let's take the traditional IRA, Carol. At 70 and a half, what is mandated? We must.
RMD is a required minimum.
Required minimum distribution. Mm-hmm. We must start taking the distribution from that IRA. Now, when let's say, for example, if you die, all right, and the monies, the funds are then passed on to the spouse. But what happens if the spouse passes? Well, there's a limit on how long you can stretch that IRA because IRS they want some taxes.
Yes,
well,
I was wondering about that.
Well, what can happen is you can designate the beneficiaries, the children and your grandchildren, all right, such that in the event of the death of the spouse, last spouse, there's a distribution that must be taken within 1 year of the death of the principal. Now, here's what happens. The beneficiaries will have a choice. Children or grandchildren, if it passes on, they have a choice of either getting a lump sum, and that would be subject to a lot of federal taxes. You understand, Carolyn? All right. Or receive payments that stretch over their life expectancy.
That sounds like a much better
so
way.
Therefore you minimize the tax bite, and that is critical. Now, non-spouse beneficiaries of IRAs do face some hurdles. A different set of rules to determine the RMDs. They have to. It is mandated they must take the monies. But in the event, if we go back to husband and wife, if the husband passed and the wife is not at the age of 70 and a half, you don't have to take your RMD.
Oh.
Okay, until you reach that age. You pass, those funds are then passed on to your children, and therefore you have to make sure that the children will stretch those monies out over their life expectancy, but they do have a choice in this matter. So you want to make sure the provisions in the IRA allow the beneficiaries to take distributions over their lifetimes. I can't emphasize enough, and to name second-generation beneficiaries. It could save you a lot of tax monies and keep your legacy going for several generations.
Okay.
Mm-hmm.
That is really, really, really good to know. Now, when it comes to retirement plan distribution, I know there are the systematic withdrawals and the lifetime annuity options. You want to go into some detail about some of that?
Now, after you work many, many years, okay, it comes to receiving the fruits of your labor. Your money accumulates in your employer-sponsored retirement account. You're faced with a few options. One, systematic withdrawals. This is where you get a fixed amount of monies, or retirement plans allow this, either a fixed dollar amount on a regular schedule, a specific percentage of the account on a regular schedule, or the total value in equal distributions over a specified period of time. Again, I don't recommend that you lose control when you leave your monies with an employer-sponsored retirement account and you only have just a few options to get that distribution, all right? Lifetime, whereas you could get a lifetime annuity option, well, there's a problem with that. If you take a lifetime payout and you pass and get one check, that's the end of the distribution. Well, Carolyn, we're pretty well at the end of our show. I want to thank all our viewers for supporting JustAskFreeman.com. And in the upcoming segments, we'll be interviewing key corporate entities and talking directly with folks of Main Street right here in this studio. And if you have any questions or comments, please contact us at JustAskFreeman.com. And remember, we're here for you, and we'll see you soon.